We can directly go to question number 4.19. Total asset employed is 10 lakhs. Direct cost is 5,50,000. Other operating cost is 90,000. Goods are sold to customer as 150% of direct cost. So what is direct cost? Is 5,50,000. Then what will be sales? 5,50,000 into 110%, sorry, 150%. So 5,50,000 into 1 point, it is 8,20,000. This will be practically my COGS. $8,25,000 minus 5 lakh will be 2,75,000. %50 of the assets being financed by borrowed capital at an interest rate of 8%. So borrowed capital will be 5 lakhs at an interest cost of 8%. At an interest cost of 8% per annum. So my interest will be 40,000 rupees. Then tax rate is 30%. I will be getting answer of EBT minus tax rate is 30%. I will be getting answer of tax rate is 30%. You are required to calculate, but first we need to complete this. So before EBT, there will be answer of EBIT. EBIT minus interest. So here will be operating expenses, which is not found out. How we will be finding out operating expenses? Yes, it is given 90,000. 2,75,000 minus 90,000. It is 1,85,000. Minus 40,000 is EBT, is 1,45,000. 1,45,000 into 30%. 43,500. 1,45,000 minus 43,500 is 1,01,500. Let us see what they are telling to find. Net profit margin. It is net profit divided by sales into 100. Net profit is 1,01,500 divided by sales is 8,25,000 into 100. 1,01,500 divided by 8,25,000 into 100 is 12.30%. Return on assets. Now try to concentrate. Return on assets can be found out post-tax, can be found out pre-tax. It can be found out pre-interest also, it can be found out post-interest also. This practically also means a return on capital employed, which we normally take it as EBIT. Right? A return on capital employed. How much return your overall asset is generating is 1,85,000. See, some of the people also takes EBIT minus this tax. Some of the book also says EBIT into 1 minus T. So they don't even consider tax benefit on interest. You can do anything, but return on asset is same as return on capital employed. If I want to do pre-tax, I can do this, which is EBIT upon total assets multiplied by 100. And believe me, this will be pre-tax because yet a tax is to be deducted. So EBIT is 1,85,000 divided by total assets is given is 10 lakhs. multiplied by 100 is 18.5%. You need to write down it is pre-tax. If you want to do post-tax, you can multiply 1 minus t and get the answer. Whenever you multiply pre-tax with 1 minus t, you get the answer of post-tax return on capital employed or return on assets. All right. Asset turnover. 3. Asset turnover. We always know how to draft turnover ratios. In denominator, this will come total assets. Turnover will be sales. Sales is 8,25,000. Assets are 10 lakhs. It is 0.82 times. This is nothing but asset turnover ratio. 4. Return on equity. Return on equity is PAT upon equity multiplied by 100. What is profit after tax? 1,01,500. What will be equity? Concentrate. 50% of assets are being financed by borrowed capital. So remaining 50% will be financed by equity. So 10 lakhs into 50%, that is 5 lakhs rupees will be financed by equity. See, total on asset side is 10 lakhs. 5 lakh is borrowed capital. So 5 lakh will be equity plus reserves. That is nothing but equity. 1,01,500 divided by 5 lakhs multiplied by 100 is 20.3%. And as we have taken after tax, this is nothing but after tax return on equity. And return on equity should be always found out after tax, because here the interest should be deducted while finding out profit after tax. So this was question number 90.